Yesterday we saw the majority of the S&P 500 down. However, one company that seems to continue to increase every single day, Palantir, is up 208% over the last 12 months. In fact, just year to date, they are up 253%. Now, right now, this company is trading towards its 52-week high of $63, and we want to cover the good, however also some very bad issues that we have with this company in terms of investors considering this in their portfolio. First things first though, we do get a triple hold right across the board, meaning Seeking Alpha, Wall Street and Quant believe you should not be buying shares, but also if you are a shareholder that you shouldn't be selling them either. Now, first thing that we want to point out that I'm sure you will have seen and stood out like a sore thumb, the forward P right now for this company is trading at 160. Now, that is astronomically high, but when we do take a look at their earnings, their more recent one, they are producing some very stellar results. In fact, they were up just 12% on that report that they had in November the 4th, and these results were very, very good for shareholders. In fact, when we take a look, their earnings per share was a nice beat, 10 cents versus the 9 expected, as well as their revenue 726 versus the 701 that was expected by the market. And as we can see here, the CEO Alex Karp did mention that they absolutely eviscerated the quarter, and they put this down to the unrelenting AI demand that they cannot see slowing down, and neither can the market currently, given that very high valuation that is put on its head. Now, we also noticed their revenue is up 30% year on year in the quarter, and their net income has pretty much doubled from the same quarter last year, 144 million versus the 71.5 that we saw in 2023. And some other points that Alex Karp does talk about in his letter to shareholders. He says the growth of the business is accelerating, their financial performance is exceeding expectations as they meet an unwavering demand for the most advanced AI technologies from the US government, but also their commercial customers. Now, the good news doesn't stop there with this company, because when we do take a look at that latest investor presentation, their GAAP net income just continues to climb higher and higher every single quarter. And this is fantastic news if you are someone who is an investor, or in fact, if you are someone that has been one of those early shareholders who was buying well before this run-up that we do see. We also look at their operating income, again looking very good on a quarter-by-quarter basis, moving in the right direction that we want to see. And as we already mentioned in that essential earnings report, up 30% on their top-line revenue. We can also see their operating margin increasing, and remember, on this channel, one thing that we like to see for high quality companies, yes, increase in revenue is fantastic, but we also want to see, are there any efficiencies to the operating margin, the net income margin, gross margin? And as we can see here, in Q3, so the same quarter last year, their margin was 29%. In the same quarter this year, 38%, whilst also being able to increase their top line. So fantastic news. And finally, we do get to see here, in terms of the number of deals closed, they continue to rise. In fact, 16 of them in that quarter were worth at least $10 million. So fantastic news for Palantir, but as we said, there are some reservations that we want to discuss, and the first one, if not the main one, is around the valuation. So when we take a look at their grading, they do get an F, and we also want to point out we're going to run it through our own valuation model shortly. With the F, this is essentially derived from the fact that their PE on a non-GAAP forward-looking basis of 160 is well above the sector median of 25. In fact, if you're buying Palantir right now around the $60 region, you are paying 537% in terms of a premium. And for those that want to use other valuation metrics, well, as we can see, you would come to the same result, some a little bit higher than others, but essentially, bottom line, Palantir is trading at a massive premium. Now, don't get me wrong, some companies do deserve to trade at a premium, but you have to understand how much of a premium is a company worth, and that is what we need to wrap our heads around with Palantir today. Because when we do look at the other metrics, their growth grade, phenomenal, A+, we love that, 25%, a lot better than the sector median of 4%. Moving forwards, 22%, again, much better than the 6% of the sector median. And when we come down to the earnings per share over the next 3 to 5 years, 26%, a lot better than the 15% of the overall sector. Now, that doesn't just stop there. We can also see that reflected in the profitability, where they did get an A. And in terms of the margin, well, 81% versus a sector of 50%. Bottom line, 18% versus the sector mean of 3.46. And we also notice their cash from operations over the last 12 months nearing the 1 billion mark, whereas the sector median at 95 million. So yes, we do get a triple hold right across the board, as well as an F on valuation, but as we've seen from the A+ in growth and the A in profitability, this company does in fact deserve to be trading at a premium. Is it worth the 500-600% premium? Again, something we do need to consider. Now, we also want to let you know that every Monday morning we do release an article directly to your inbox where we talk about severely undervalued stocks that do deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can start reading straight away, where you'll also be able to gain access to 40 undervalued dividend stocks for the month of November. Lots of information for each, the upside that Wall Street see over the next year, as well as a spreadsheet of 22 undervalued dividend stocks that Wall Street themselves believe right now have the most upside out of the whole S&P 500. So click below, sign up, and you can start reading straight away. The other parts of our analysis of companies is looking at insider and institutional movement. Starting off with insiders, 13%. We also notice a significant amount of insider selling, 1.5 billion over the last year, which actually from memory is probably the most that we have seen on this channel. 406 million in the more recent quarter of Q4. And when we take a look to see who these insiders are, well, we have one director who sold on the 8th of November, so literally just last week. In fact, the CEO himself also sold a day before, and he sold quite a large chunk, 4.5 million shares, worth around $248 million. Now remember, we do want to be consistent on this channel, and we do believe that insider selling isn't a bearish signal. Look, they sell for many reasons, personal or financial, but again, if you want to use this information in your own investment thesis, you can. That is a significant number of shares, but again, remember, no one can time the top. This could be just the beginning of the run, or as we will come to take a look in terms of the valuation, it does look to be overvalued. Again, you can come to your own conclusions and use this in your own investment thesis. When we do the same analysis, but for the institutions, 46% ownership, 1 billion worth of sales over the last 12 months, 3 times as much buying by the institutions, again in the same time frame, and we also notice a significant amount more buying in Q3, 1.2 billion versus 268 million. So are the institutions loving this company? Yes. Are they bullish? Yes, as we can see. But as always, do your own due diligence, never copy insiders or institutions. Now, before we jump into our own valuation, let's have a refresher of some of their key metrics. Their free cash flow, whilst negative in 2018 to 2020, has started to tick up in the right direction, with growth expected from 23 to 2024 to around 44 cents. So that is always good to see. Now, sales growth, one thing we don't want is for this company to start slowing down like we have seen over the last few years, because the valuation is very rich. We are expecting as investors that so does the sales increase in the likely manner. Now, 25% on a trailing 12 month is a good sign. Hopefully this was the lows of 2023 at 17%, but definitely something we need to keep an eye on. As we just saw for the more recent quarter, that is up 30% on a year-on-year comparative. And we can see their top line has come up very strongly, 600 million in 2018, 2.23 billion in 2023. Now, we also have to flag, in terms of shares outstanding, they have been diluting your position as a shareholder over the last few years. 544 million in 2018, 2.41 billion in the latest quarter. And as we can see, this is something management do on a very consistent basis. So something just to be aware of, something we did think to flag. Now, ROIC, what this is showing us is that when we do previously look at financial statements, they were making a loss. In fact, 2023 at 3%, it means a good sign. 8% trading to a month as well, so they have turned a profit, and we did see that when looked at their investor slides. We do ideally want to see this though at 10% minimum, just to give us faith management are able to effectively allocate their capital. And we can again see that operating margin only turned positive in 2023, and based on the increase on the trailing 12 month, hopefully this can be sustained, move in the right direction, and ultimately this is what we want to see at 16% at a bare minimum. So again, hopefully something we can tick off from 2024 onwards. In terms of free cash flow margin though, over the last 3 years and on the trailing 12 month, looking very strong, 40%. Again, investors will love to see this. Then we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. Remember, this reflects the balance sheet strength with these being the number of years it would take the company to pay off all of their debt net of cash on hand. What this signals to us is over the last 4 years, on a trailing 12 month and over the next 12 months, it won't even take Palantir one day to pay off all of their debt net of cash on hand. Very strong balance sheet, so does look good. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So our intrinsic value today comes to $41, and how we got that is the DCF model. So we'll just run through that now. We have the free cash flow year on year, negative average growth as it has gone from negative to positive a few times. Now we've gone for 30% moving forwards with a low, medium and high rate here, 25, 30, 35. With the 30% medium and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here $41 intrinsic value, meaning if they grow their free cash flows at 30% year on year over the next 10 years and beyond, we are looking at downside of 33%. Now remember, these numbers are subjective and you can always grab a copy of this model by clicking on the pinned comment below, but just to show you for transparency, at the 25% rate moving forwards, intrinsic value would be $31, meaning downside of 49%, and at the 35% level, we can see $54, meaning downside of 12%. So even if you believe right now that it will increase by 35% year on year moving forwards, you are still looking at an intrinsic value of $54, meaning downside of 12%. Now we want to take the medium rate today of 30%, where typically what we like to do on this channel is put a margin of safety where we start off with 10% and execute buy the stock given if it meets the 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Which means right now we believe Palantir is trading at a significant premium, but for those that do want to know, based on the information we've run through, 10% MOS a buy at $37, at 15% around $35, and at 20% around $33. But as we said, no margin of safety, and Wall Street themselves believe even lower. They have the price over the next year at $35, meaning downside of 43% over the year. As always though, do give us your thoughts. Do you believe that actually no, this is a buy now, it will essentially evolve into its valuation? Do you believe it's a hold like we saw with Wall Street seeking alpha and quant? Or in fact, do you believe that Palantir right now is a sell and this is the top for the foreseeable future? We also want to let you know, for those that believe this company will eventually become a 1 trillion market cap, at the current price, the market cap is $138. So Palantir, if it does meet the 1 trillion space without any stock splits, the values of the shares will be $442 each. As always, give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.